Everything said in this show is not investment advice. It's me and Mike's personal opinion. It's what we do and implement in our investment strategies. So go out, do your own research, because we don't know the future. Sadly, I can't see into the future. I wish I could. Today, you're going to learn about how stupid you actually is and why investing in ETFs is the right option. Because yesterday, listening to a great book about investing, apparently most people, if they win $10,000 and inherit them for their grandmother, that depends how they spend $10,000 emotionally. When you think logically about it, yet it's like $10,000. But all of us sometimes get into that mindset where we're stressed and then we just do things emotionally, and what we tend to do. So this is why you shouldn't invest in ETFs, because stocks and single stocks can evoke a whole lot of emotion. And Mike has probably experienced that a lot more than me.
Yeah, so what we're talking about today, folks, is why ETFs are a really good vehicle for some people and why individual stocks are best left for people that can have a very tight control on their own emotions. As Moss just mentioned, our human brains are really stupid about certain things. And one of those things we're dumb about is money. It is bizarre how someone will come into a pile of money, and how they spend that money depends on how they got the money. This has been proven over time through several studies. It makes no logical sense. But we must always remember, when it comes to investing, our emotions are our own worst enemy. So jumping right in, an ETF it stands for Exchange Traded Fund. Before these things were created, people would buy and sell shares in individual companies through the stock exchange. Then in the 1970s, the idea of mutual funds came out, which was you buy shares in a fund. That fund then uses money to go buy shares in a bunch of stocks. So all the stocks are collected in one place. This has great advantage for people who don't have a lot of money to invest. And again, this math goes way back, but like all investing math, it's very simple. You can do it with a pencil and no calculator. If you hold somewhere between 10 to 20 individual stocks in good amounts of money, that's a good long-term strategy for many people. If you don't have enough money to get to that point, or you're not there yet, mutual funds were a natural thing to do because it lets you get shares in a bunch of different companies that you couldn't otherwise afford to buy because you didn't have enough to buy into all of them. Then later, because financial people are very creative about selling you lots of fancy sounding products, one of the good ones that came out was the exchange traded fund, which is the idea of it's a mutual fund, but unlike a normal mutual fund that is priced once a day, so it doesn't have there's no variation during a 24-hour period. It can only change price once every 24 hours. So it's a very steady thing. It's not traded rapidly. But of course, then came people that wanted to speculate on funds, and they said, well, let's make an exchange traded fund that trades all day long and the price goes up and down. There's all the volatility, which that can be good or bad depending on your investing goals. The big advantage of an exchange traded fund for beginning investors is they're cheap. A typical mutual fund might tell you have to put in $1,000 or $1,500 to get in. Whereas an exchange traded fund, you can find them selling as for little as $5 or $10 a share. So $5 or $10, you can get a piece of one of these things. So that's the basics of it. So Moss, what are some dumb things you've seen investors do?
Well, first of all, I just quickly want to share one bit before I answer your question. The reason why humans are so dumb with money, it's because nature can't keep up with technology. You still live out in the savannah, being afraid of saber-toothed tigers and catching gazelles. Your biology still lives there. So money wasn't existent. And it's much better to be scared of a saber-toothed tiger that's not there than not being scared of one that is there. That gets you killed. So, like, the most common mistake I see is people. I do this to Mike as well, but I do this to Mike because I know how good he is at investing. But I see a bunch of people on a bunch of Danish investment groups that ask complete strangers for investing help. Like, first of all, these people, like, some of them give very good answers, but like some people like just want to make money, so they might recommend you a stock they just bought. And not doing your own research goes into that, which is something you should also do when we speak. Because what is your goals? What is their goals? Why are they buying it? And end of the day, you don't know the person. Like, you should ask for really important advice, which for most people investing is, because this is how you're going to retire. This is how you're going to have money. Even in Denmark, without having a welfare system, I jokingly, casually go around and say, I'm never going to be able to retire on the Danish government because they keep like raising that age. That's on me. So that is a very important thing, and you don't want to leave that decision up to some strangers. And I don't think the bank is the right option either. You want to find people that you like and trust, which you can talk about investing, which is why we made a Telegram group. If you like us and trust us, join it. If you don't yet, then don't. Then you shouldn't take advice from us, actually. So always ask, why is that person saying that? Is there some reason for it? Always be skeptical. Like, in that nature of being scared of that saber-toothed tiger that isn't there, that can be very helpful in some cases, if done right. Always think, what would this person have to gain? Because the only reason why I, in a complete, like, do things where another person might be hurt, if I have absolutely nothing to gain from doing that, why would I do it? But if there's something to gain, then you should definitely look, would he do that? Because you don't know me enough, personally. You can make an educated guess, but you don't know. Only I know. Mike doesn't even know. So be very careful. And also, when you go in and actually look for stocks, ETFs, go to multiple places, like go to YouTube. I don't just take Mike's word for something. I go ask YouTube as well. And this is not that I trust Mike. But going into that, Mike tells something in one way that makes me pick it up in one way. If I go to YouTube, I go to Fisher Investments, I go to Google, ask them about ETFs, then my picture of ETFs is going to be a lot more whole. Mike sometimes misses out shit I wish he would have told me when I like look up on a YouTube video. Well, it isn't important to him, but it is to me.
Yeah, and this is a good point that you've highlighted, Moss, is no one person can remember everything and no one person can share everything that they know. It's important to go to multiple sources. And when you're choosing the sources you're going to listen to, look at their track record. There are many, many, many financial advisors and experts and so-called gurus out there that don't publish their results. Now, at Company Saviors, our results are available. You just email us. We'll send them to you, show you exactly what we've done the last 30 years. But if someone won't do that, if they won't show you real results, you might not want to listen to them. The other thing to pay attention to is, of course, whatever the financial media is saying is already priced in.
Don't do that.
So it's widely known, public information. Don't act on that information unless you know something they don't. And that's really hard to do. And most people can't do it because most people don't see things that aren't there. But some people have insights, and I go to the example of Albert Einstein. He had certain insights into the way physics worked. And it was clearly observable to anyone. He didn't come up with something that wasn't there, but he saw it in a way that nobody else could see it. And so if you can't do that with investing, don't copy what the media is telling you because everybody else is copying them too.
And this is
also remember, every time something's sold in the market, there's someone buying that same thing. So while you may think that, it's a time to buy this thing, you must ask, why is the seller selling it? always ask that question.
This is why I believe ETFs is so important. Because the reason why me and Mike spoke about stocks in the last episode, I realized I'm getting ahead of myself. Because ETFs gives you that peace of mind that allows you to take the time to make the right investment decisions in stocks. Because if you don't find the next stock to buy in the next year, just keep putting money in ETFs and it's gonna compound. So it allows you to have the time to analyze so you don't make wrong decisions. Of course, you're still gonna make some, but it gives you that like peace of mind that's so valuable. There's a limit to how much information a human brain can take in.
Yeah, for sure.
And also, if you're not like actually interested in stocks and numbers and business, that says nothing to you. Just buy ETFs and mutual funds. Exchange, like do that, because the other thing takes time. And
doing your own research takes a ton of time, and an ETF has also the advantage that because you could pick a few different ETFs, put some money into each one, and watch how they perform over time. And I'll tell you two things. It'll tell you how the management team managing that particular ETF, how well are they doing? And you always compare them to whatever their benchmark is. All these funds have a benchmark, but see how they're compared to that benchmark, and then decide, is it worth it to remain in there, or do you want to move your money somewhere else? And you can do this at low cost through ETFs. So that's one of the really neat things about them, is you can eventually find a financial management team that you really like.
Exactly. One thing I just thought about we haven't mentioned, what do you actually look for by buying an ETF? Because you can also make the wrong decision. And the things that I go through, and I'll let Mike elaborate after, this is just going to be great for YouTube short. It's number of holdings, the expense ratio, and the location. Like that's the three main things. And of course, the industry. Like that's the things you want to look at, and you want to think internally, make your own decisions so you don't just jump on the market, because if the market already is talking about it, it's too late. If you didn't understand Mike when he said it earlier, let me put it simple. It's too late. Don't buy it. The big money is gone.
Yeah, by the time people are talking about something, it's too late to buy in almost all the time.
And also when you see... Yeah, go ahead, Mike.
You can watch that investment. Most websites will let you set an alert that will email you when the item gets to a specific price. We've done this very successfully. You know, one of our big hits was Apple. By the time I realized we should be buying into Apple, it was too late. It had climbed so far, so fast that, as Moss says, all the big money had already been made at that time. However, nothing goes up consistently over long periods of time. There are always volatility. There's ups and downs. So I set an alert. When it gets to this price, let me know. And when it hit that price, we bought a bunch of it.
They just had a bad financial report, right?
Price is. You know, your price that you want to buy at is something you have to determine for yourself. But yes, they happen to have a bad moment in the history of the company. This happens. And if you are paying attention and you see something drop, but you don't really understand why it's dropping, dig deeper, because sometimes that drop had nothing to do with the company. It may have been some company executive got caught doing something, or somebody said something on social media. I mean, there's a lot of reasons that something can drop that may have nothing to do with how the company operates. So look at things like sales. What's the quality of their sales, and how are they going to continue to grow their market? Look at their expenses. Now, when it comes to an ETF, you don't have to dig that deep. What you look at with the ETF is what Moss already said. What's their expense ratio? That is what it costs you every year to own that thing, because nobody's running ETFs for free. If someone tells you it's free, They're hiding their fees from you. They're
Run.
getting paid. So
Run.
So expense ratio, how many holdings? A fund that has thousands of stocks, they're clearly not paying attention to all those companies. It's too many. Or they've got a giant staff of people looking at them, which again, that's going to hit the expense ratio and you're paying for that. So look for one that has a reasonable number of companies that they contain, and also what sectors are they in?
Reasonable number? What's a reasonable number? Just for audience.
For me, the reasonable number is anywhere from 200 to about 50, somewhere between those two numbers. But that's me. Other people like to have a broader range with 500 companies. There are concentrated ETFs. For example, if you were buying an ETF in the advertising industry, there's 10 companies worldwide. So it's only going to hold 10 because that's what's out there. So yeah, sometimes that is limited by the industry. I would like to caution people, don't buy things that are ETFs of other investment products. For example, don't buy a Bitcoin ETF. Now, why I say that, and I'm not an advisor, I'm just saying this is my opinion, what I wouldn't do this. If I were going to buy cryptocurrency, I would buy cryptocurrency. I wouldn't buy an ETF that buys cryptocurrency because I'm paying an extra fee to own that ETF that is buying an investment instrument that I can buy directly. Some people like to buy gold ETFs. That's a little different because in gold, you have to decide, do you want to buy a processor that refines the ore and turns it into gold? Or do you want to, or extracts the gold from the ore? Or do you want to buy a company that mines the gold? So again, in the mining industry, there's not very many companies. You could buy an ETF that holds shares in every mining company. That might not be a bad idea. But you would not want to buy an ETF, or I would not want to buy an ETF that owns shares in people that sell gold stocks, because again, I'm doubling up the fees.
Makes a lot of sense.
Yeah, I mean, it's probably a much easier example is apples.
I really like the Bitcoin example actually, because it's not very hard to hold your old Bitcoin. You can go in and like build your own crypto ETF. You can even go into all the crypto ETFs. Look, what do they hold? Buy the same thing. It's not very hard.
Now, there is a whole realm of ETF trading going on with people that have very high-speed computers, and they're looking for minor changes in the price of an ETF. These are momentum traders. And they'll say, they may buy, I'll just use an example. They may buy $1 million worth of a specific ETF, and they're waiting for the price of that ETF to move 50 cents. And then they'll sell because they've just made a bunch of money because the amount they put in to begin with.
Yeah, the volume.
This is what gives ETFs their volatility, whereas mutual funds are only priced once a day.
And don't be scared of volatility, as Mike talked about. Things go up and down, and probability has no memory. So if something went up 1 year, the chance of it going up and down is still 50-50. No matter what. I
used to see this all the time with the, we teach economics and finance to people, and you could go and flip a coin. Is it going to land heads or tails?
Most cases,
the probability.
For most people, doing heads or tails on 10 stocks is probably a better investment strategy than what they're doing. And this might be you listening to this.
Yeah.
A monkey could beat you.
Because here's why. Every time I flip that coin, it's the same odds.
Yeah, no emotions into it.
50-50 every time. But many people make the mistake in investing of thinking, well, if I got tails 7 times in a row, it has to come up heads pretty soon.
Just think about you at the roulette table, for example. And I used to be a victim of this because I'm like, okay, the chance of it hitting red 7 times in a row, that's low. So it should hit black. That's not correct. Because no memory. And most people, if they're not been told this principle, they would feel more safe betting on black than red if it's been red 7 times in a row. even though it's 50-50. Or it's not quite because there is a green. That's how they make money.
And this is how the best mathematicians and physicists in the world get banned from casinos. Because those brains go into a casino to play the games, and they understand the odds better than everybody else at the table. So it makes them better players. Now, in the stock market, sadly, there are many people who approach the stock market like it's a gambling. You should never do that. And if that's your personality, you definitely want to be investing or using some kind of investing professional to help you that will separate you from your own emotions.
That's not going to tell you anything. Yeah. He's just going to be like, when you go and ask, he says, no, you can't know this. No, I know what I'm doing. You want that kind of person. If you kidnap his wife, he ain't going to show you the stock still. You want that person to invest for you.
If you're a gambler personality, most of the time you're going to lose in the long run because your emotions are going to take over your logic. And as Moss has said a couple of times, probability has no memory. And the stock market is known as the great humiliator for a reason. This goes all the way back to the, Dutch and Danish and other stock markets from the 1500s, 1200s, all the way back. People that got emotional about investing tend to lose out.
Exactly. And to kind of bring another point full circle, because last week's show, me and Mike talked about lithium mining. And we got a comment that basically talked about, no, lithium is being replaced by zinc now. See, this guy, I like that comment because I'm like, good job doing that fucking research. He went out and went like, no, I don't agree with what he's saying. Zinc is going to replace that. That made me go in and research batteries and how they're doing it. And nowadays, sodium is also getting into the mix, and they're kind of mixing it.
Yes.
So go out and just make your own research, because nobody is an expert on all the investment industries.
Exactly.
And that's why ETFs are good, because they allow you to cover all the industries where you ain't an expert. Go in and buy stocks in industries where you have knowledge, not too much of an emotional attachment, as I learned both from Mike in this book and every other successful investor. It shouldn't be too fun. Getting too much fun, having too much fun investing has never had a good result in the long run.
And to circle back on the lithium thing, we were using that as an example for people. We don't give investment advice on this show other than how to approach investing, how to think about, how to keep your emotions under check. These are the things, but specific things. We didn't recommend lithium. We're using it as an example. The problem with other technologies right now to replace lithium is none of them can be done at scale. So even though, as that commenter said, that's a possibility that it could replace lithium, that's true. It is possible. If that's an area of interest to you, do your research. If you want to invest in that area, figure out who's going to own the mines, who's going to do the processing, who's going to get it to market. Those may be 3 different industries as it develops, or you may find a company that's integrating all 3 together. But these are things you would think about to start digging into that realm.
Exactly, and think to yourself, which industry is going to be the most lucrative? There's a bunch of data to be had, because there's companies that's not the exact same thing with lithium at the moment. Go in and look at those numbers. With zinc mining, they're probably going to be similar. I don't know. I'm not a mining expert, neither a financial expert. I just speak my mind, and sometimes I'm right, sometimes I'm not. At least I'm able to detach my emotions from my investing, which makes me confident I'm further ahead than most people.
And we're always happy for comments. Obviously intelligent comments that have to do with the topic will respond. The other kind of comments, go ahead and make them, but we might not answer you. Cause
if you go and decide you're gonna roast us, please make it funny. That guy that called us, the guy that called me that chef from Ratatouille, I can't remember what he called you. That got me cracking up. I don't mind that one. If you got jokes, feel free to roast us.
Definitely.
I don't mind. I love those comments. Like waking up and like, what? That's a violation, but it's kind of fun though. I like it.
Hey, good funny comments are always welcome.
For sure. And appreciate everybody watching the show. Thank you very much. As mentioned, join our Telegram group down below to get our opinion on investing, stocks, and how we see the market going. And this is just what we do personally. You can follow us, that's your choice. And if you don't want to follow us, again, that's your choice.
And if you want to put your track record up against ours, send us an email. First call at companysaviors.com. Just send it in. Let's compare notes. If you're really good at investing and you want to challenge us, let's go for it. We always like a good challenge.
We love it.